Coming up today, stocks lower ahead of Jackson Hole. Are we about to break out to new all-time highs? Or is a rug pull incoming? More volatility ahead. Oil bounces back, and the breakthrough of Samsung Silver. It's a big one today, guys. Let's get it. And there we go again. We've just done the dreaded bearish engulfing candle today. That's where you gap up above yesterday's high and finish below yesterday's low. Looking back at the last few times we've done that, a little bit here to start off last month, and just going back in history. The last few times we've had a bearish engulfing candle, we have seen some pullbacks. A little bit there in May, again back in April, bearish engulfing. S&P 500 pulled back for a few weeks. Before that, it was all the way back in July last year. I remember that day vividly as well. Really big bearish engulfing candle. Quite often see that little retrace, and then it fell over for a few months after that. And it wouldn't be so surprising, would it? Had a pretty good bounce back. Certainly a lot of other markets out there not so excited about the economy around the corner. But it's not unusual after a good multi-week run like we've just had. See the market take a few chips off the table, lock in some profits ahead of the big Jackson Hole speech tomorrow morning, which historically Jay Powell uses as a platform to give guidance for his monetary policy going forward. And this one's just coinciding with kind of crunch time for Jay Powell. It's been on hold for over a year. Now's the time to really act. However, stick with me because I'll get into all that a bit later on. Just looking at market color, it wasn't a complete bearish breadth of a day. We still have industrials, financials, REITs, and the defensive sectors all above their 5-day moving averages. Really got a lot of weakness in energy. That's definitely the weakest sector at the moment. And it was actually mega cap tech that pulled back the most today, about 2% as a group, thanks to a pretty sizable down day for Nvidia of 3.7%. And stick with me because I'll show you what insiders have been doing in this stock lately as well. In addition to hedge funds, what they're doing, mega cap tech, I'll share with you some data and research. Also saw Tesla come off 5% today. And there's a look at today's heat map to really visualize that sell-off, especially in semis and mega cap tech, whilst financials, healthcare, and a few of the defensive sectors actually held up there today. And so we just had a down Thursday, bearish engulfing pattern. Thursdays had been the most bullish day so far this year. Tracking at an annualized return of 46%. Friday coming in second best, 34%. Going into weekends is normally bullish in a bull market. And so we're all on the edge of our seats waiting to hear exactly what Jay Powell's going to say tomorrow. How dovish or hawkish is he going to be? What does he think of the jobs market? What's his view on inflation? Is he going to mention the election? Does he see any signs of distress with the consumer? All of these things the markets want answered so they can reprice the start of an easing cycle. And we can see a little bit of bullish seasonality around these Jackson Hole speeches. Markets can come off going into them and at the start of them. However, they can be bullish coming out of them, but they can also swing around up and down like we can see in this chart here going back to the late 90s. The 1 week post S&P 500 return after the Jackson Hole conference can get some big up and down movements, especially like now when monetary policy is at an inflection point, which we're most definitely at right now. Like I said, the Fed's been on hold since July last year. It's about 13 months, a little bit longer than average. And so now's about the time the markets are expecting them to start cutting next month. And just looking back the last 10 years, during the Jackson Hole meeting over the Thursday and Friday, the average return in the S&P is slightly negative, however slightly positive for the entire week. And so are we going to get that big bullish rip to new all-time highs? I'd have to do it right in the face of that bearish engulfing candle today. And I'd say that's possible if Jay gives any hints of wanting to start big with his easing cycle, 50 basis point. That could get the market excited. Or what happens if he gives a hint that there's still the possibility he may stay on hold next month? Do not think the stock market will like that. May get the classic rug pull after this multi-week bounce back. However, that is hard to see 2 months outside of a federal election. Pretty sure he doesn't want to rug pull the markets going into that. In my opinion, he'd probably love them to stay flat, and I think he'll come out with moderate language. I don't think he wants to light the markets up, get animal spirits going, possibly reignite inflation. Truth is, the stock market's just fine. It's the real economy that needs helping out. Many consumers struggling. So you may want to balance that with indicating that he is going to cut rates. However, they're going to do so cautiously. But I'd be very surprised if he indicated that they're going to stay on hold. Because like Janet Yellen just told him, we don't see new all-time highs tomorrow. You'll be doing your printing out of Alaska. And just reading some research out of Macquarie, they share a similar sentiment, saying they wouldn't be surprised by a moderate tone from Powell, but doubt that it'll be very dovish to try and light the markets up. They also point out any post-convention rally in Kamala Harris' polls next week could contribute to further US dollar weakening, as we've been seeing a lot of lately. But I'd agree with Tom Lee and Mohammed Al-Iran, amongst others, that criticize the Fed for being too data dependent. Because whilst it can't be ignored, the thing is data is backward looking, where they've got to be deciding their policy being more forward-looking. And so they have the opportunity to get in front of a potential recession and start cutting rates now, That's the whole idea. Lower the cost of capital, loosen lending, try and stimulate the economy before it goes down the toilet. And if they're too data dependent, it might just be too late for them to get in front of a recession. And so if they don't cut next month, I think they'll face more criticism for that than if they do cutting right in front of an election. Even though that's going to look bad, I think it's completely justified. However, whatever happens tomorrow, whichever direction we move, could get a big day. 2-3% in either direction. Markets will get past it. However, we're still not out of the woods just yet, looking at volatility. Still in the middle of the most volatile period of the year in the stock market. And just looking back in history, at average volatility during election years, we are right here. Seasonality suggests volatility goes higher over the next 2 months heading into the election before it peaks out just before the election. And like a lot of news events, the market gets worried going into it. Whatever the result is, it accepts, then it calms down. And that's typically a low volatile period in the market. End of year, start of year. And here we are on the VIX index today. We're already creeping back up. 17.5. Kind of unbelievable. It's on a 14 handle. To start the week off and staying even more elevated is volatility of volatility. And we're getting a bit of a bounce back up in volatility risk premium. Still negative territory. I'll be keeping an eye on this. If we go back into positive territory, that's option dealers forecasting more volatility around the corner than what we're actually getting in the market. But implied correlation is still low, 12%. Still a lot of dispersion out there in the stock market. But also bond market volatility and commodity market volatility still at reasonably firm levels as well. And so just looking back at the last 2 August months we got, they finished lower. Even worse for September. The last 4 Septembers we had finished lower, with 3 of them above 5% as well. But just stepping back a bit and just looking at the amount of cash out there, there's just so much. Just exploded after COVID. Looking at total net assets and money market funds, you can see back in January 2009, ran up for quite a few years, even throughout that tough time, 07, 08, peaked out just below 4 trillion, and that was pretty much the low in the stock market. March 2009. Cash fell off, went invested into the market, started already building in 2019. Then we got COVID, just absolutely exploded. Thanks to the government just printing and handing so much out. It's gone from 3.5 trillion to 6.2 trillion. And if that starts earning a lot less interest and we don't get a recession, then all those stocks yielding 4-5%, many of them blue chips, been around for many decades, they're going to start looking a lot more appealing to all those cashed up boomers who like to chase yield and don't want to see their monthly payments drop too much either. We always see a lot of charts of credit card debt exploding in the state, and it's true, it's gone up a lot in dollar terms, now above $1 trillion. However, with a lot of stats, it's not a bad idea to adjust them for inflation. Look at the real number. That's still actually well off highs from back in 2008 when adjusted for inflation. In fact, just looking at household debt to disposable income, as a percentage, the US is actually quite conservative, 97%. Australia and Canada, on the other hand, both of whom have had a love affair with real estate for many decades, 184%, 175%, levered to the gills. Every third person's a property investor, and for many people, all they've known for the past 20, 30 years is ever-increasing housing prices, thanks to the secular bull market in bonds. That's when interest rates peaked in the early 1980s, which I'm sure some of you watching this may remember. I think a lot of people couldn't even imagine having a mortgage at 15% these days. However, that's what it was back in the early 80s. And like I said, the bond market went into a secular bull for the next 40 years, with yields consistently dropping. That's a huge tailwind for residential real estate, where the cost of capital has a huge impact. Not to mention pro-investment policies, interest rate deductibles, easy loans based on equity, etc., etc. And we can see that in plenty of data, just how overvalued Canadian and Australian real estate has become, along with New Zealand and to a lesser extent the United Kingdom and the United States. Canada's inflation-adjusted house prices over the last 20 years. Looking at Canada's home price to rent ratio, deviation from the historical average. It's up there with New Zealand, Norway, Belgium, and Australia, with actual contractions in Germany and Japan. And there's a visualization of just how expensive Australian real estate has got, inflation adjusted. So the multiple of the average house price versus the average household income has exploded at all-time highs. In other words, housing affordability at all-time lows. But like I said, a lot of people in the market have been investing in it this period here, and they've been conditioned to believe that that's normal and should continue on for infinity. So even though household debt in the States is not all that bad, we do have a rise in foreclosures on commercial property. Commercial real estate still not out of the woods. The markets are just not pricing in any tail risk at all, because the Fed's pretty much already gotten there and backstopped it all. In fact, a lot of private equity is using this as an opportunity to buy up a lot of these properties really cheap, renovate them into residential property if they can, turn commercial offices into residential apartments, and they can unlock a lot of value. Good news is we do have inflation coming down overall, just not in necessities. In the red line here, non-discretionary year-over-year percent change in PCE, still on a high 3 handle, whilst the discretionary component now down at a low 1.1. That's the consumer really pulling back on things they don't need, but there's still that inflation there in staples. And so it looks very likely we're going into a rate cutting cycle. And looking back in history, the S&P 500 year-over-year change in the blue and red here, plus 20, plus 40, minus 20, minus 40, and then the Fed funds rate in the black line, you can see the market quite often pulls back when the Fed funds rate drop. Doesn't happen all the time. Like in the early 1980s, interest rates had significant drops pretty much over the whole decade. Stock market didn't really do more than a 20% pullback. Same in the mid-90s, we had significant drops in the interest rates in the early 90s and in the mid-90s as well. Stock market pretty much held up for the whole decade. However, the early 2000s definitely had a pretty lengthy bear market. Same with 08, 09. Can't even really call COVID a bear market. Barely shows up on the chart there. There's 2022. And so it looks like interest rates are about to come down again. And there is a good chance we can see the market pull back during that time. Because the fact is, S&P 500 valuation isn't all that cheap, sitting here in the mid-20s. Looking back in history, whenever the market is trading around this valuation, the subsequent 10-year return is pretty much flat. And it was interesting today to see mega cap tech pull back a lot more than the rest of the market. And we're actually currently tracking this quarter for the rest of the S&P 500 to outperform the Magnificent 7 for the first time. You can see in the dark blue the Mag 7 performance, Q1 2023, huge outperformance just like Q2 last year. Even when the market dipped, Mag 7 held up better. Then started off this year really strong. However, we did see that rotation last month into small caps. Even though it's pulled back a little bit, the rest of the market still holding up better so far this quarter than those big tech stocks. And just looking at some research from Goldman Sachs out there today on what hedge funds are doing this month in August, especially since the 5th of August, when we got that VIX 65 event, they've actually been net sellers of stocks, especially in the US, selling large cap stocks, with tech stocks being the most sold sector. Shorts been led by semis, big degrossing out of consumer stocks. They're still buying small caps, and they're actually gravitating towards buying more high dividend stocks such as energy, utilities, and REITs being the most net bought. Kind of similar to what I'm doing myself. I'm leaning towards buying more defensive companies with solid balance sheets, better to withstand a recession, and I'm being pretty careful around the tech and growth stocks as well. And it's interesting to see hedge funds selling a lot of tech stocks because we've been seeing the tech company insiders offload a lot of late as well. Looking at Jensen Huang, he sold over $800 million worth of his own shares just in the last couple of months alone, which is not really a bullish thing. And I mean, just look at that 1 monthly chart of Nvidia. What a rise it's had just over the last 2 years. Definitely looks stretched. It's definitely consolidating somewhat. Reversal signals on the monthly chart. Could be setting up a bit of a bearish divergence on the DSI if this bearish engulfing holds. But like I said, they report next Wednesday night. And who knows, if they do break out to new all-time highs, surprise a lot of people. It's definitely in the face of all that hedge fund and corporate insider selling. Because there's a look at the semiconductor ETF as well. Even though we had a nice bounce back from August 5th, this could still be a topping formation at play as well. Just getting on to the macro, we did see weekly jobless claims edge a little higher today, coming in at 232,000, just up 2,000 a little bit from what economists had been forecasting. Showing the jobs market still softening a little bit, but not too bad, especially when you look at this chart here of the 4-week average of initial jobless claims as a percentage of the workforce. Still pretty low, is turning up. However, after what we saw yesterday, it's hard to know what to believe out there. Whole media and market keys so much off these jobs figures released each month, and we find out a year later, oops, they were wrong by 30%. Nothing to see here. So it's okay for the government to report their figures to us wrong by 30%. However, what happens to us if we report our figures in income and business wrong to them by 30%? We'll literally get locked up in a cage. So if interest rates are about to be cut, well, that's going to affect everyone that has savings accounts, money market funds. If you're a cashed up boomer, anywhere you can lock in 5% for as long as possible may not be a bad idea, according to this article. Because whilst it's impossible to predict interest rate for an extended period of time, so the odds do favor them going lower over the coming year. And so like those with mortgages or getting into the market, sometimes it's not a bad idea to fix half and leave the other half floating as a way to kind of diversify your interest rate risk. Because the 2-year bond yield, that's already at 4%. So if you're going to buy government bonds directly, they're already marking in lower interest rates. But whatever country you're in, CD, term deposit, whatever they call it, anything that can be locked in close to 5% may not be a bad deal here. And any account that offers tax advantages, good idea as well. If you can get yield with a low tax rate, that always helps. And speaking of taxes, post came up on my feed today from Zero Hedge, who are normally quite cynical. However, they had a good point today based on all this talk out there of the government potentially introducing an unrealized capital gains tax on the very wealthy. That is, if their $100 million portfolio is up 20% one year, given a $20 million unrealized gain, they'll get a tax bill on that. However, like Zero Hedge points out, the rich will find loopholes and or leave the US, like we've seen plenty of times in history when governments trying to do that. the rich just move country, or at least for their residency status. Then the threshold would drop to 100 million, 50, 20, 10, and eventually everyone. And whilst a lot of people might write that off as zero hedge just being overly cynical, they do actually have a good point based on history. A lot of people might be surprised to know there wasn't always an income tax. And I'm not just speaking about America, but pretty much everything I say applies to all Western countries. It's all very similar. So up until 1913, Americans kept all of their earnings. There was no personal income tax, but America still had great infrastructure, standard of living, education, healthcare, all of that stuff. And I think a lot of people will be surprised to know that pretty much all taxes are introduced at first in a really small way, often just on the wealthy or the rich. That's how the government kind of sells it. Just a small tax on a small amount of people, and that's why most of the people voting don't care, because it doesn't affect them right there and then. And that's what they did back in 1913. The personal income tax was just introduced to target the wealthy, and the marginal tax rates started at 1%, went up to 7%. In fact, looking at inflation-adjusted dollar amounts, even going back to 2015, not even using this year, we know how much inflation we've had since then, you would have had to earn about $500,000 before you started paying your 1% tax, and you'd have to earn $12 million for you to pay 6% tax. Here we are 110 years later, and look how this personal income tax has progressed. No longer starts at today's equivalent of $500,000, starts right away 10%, not 1%. And then if you make over $500,000, 37% of everything you make goes straight to the government. And this is not including your goods and services tax, amongst dozens of other taxes all governments slap on us. And so if we don't all speak out against this and push back against it and vote differently, then guess what they're going to keep on doing? Taxing us more. Bigger government. They control more of society's capital. And don't ever let a politician tell you that weakening your own home country's currency is a good thing. That is, unless you want to go the path of Venezuela or Zimbabwe or some other banana republic. You want to keep your currency strong, as that's what your wealth is denominated in. And if the US dollar becomes too weak, a lot of big investors around the world may begin to abandon it, and it just adds weight to the BRICS country mission of de-dollarization. So reducing US government debt is key to upholding the value of the US dollar and allowing the US to retain their global currency reserve status, which gives them a huge advantage. And there's a look at the dollar index futures today. Like I said, a bit short-term oversold here, getting some reversal signals. And even though the dollar bounced today, we still got a bit of a bounce in crude oil as well, which is not a bad thing to see crude find support at these levels, just like the 10-year is as well. Something else I'm looking for to find support. And so it appears to be more sideways action in the oil market. If it really loses $70 a barrel, that's the market saying it doesn't see much consumer demand just around the corner. Just like if the 10-year started trading below 370, that's forecasting really lower rates for a long time. Did see a little bit of a pullback in the gold market today. Been getting a lot of attention of late, and be surprising to have a little pullback here, and maybe just a few chips off the table going into Jay Powell tomorrow. We could get some movement across all financial markets tomorrow. Pretty much everyone's expecting him to come in dovish. It's just how dovish he will be. If he came in hawkish, that would be a rug pull, which could also rug pull gold, which is looking forward to lower rates as well. And there's a look at gold futures, still marching higher in a well-defined uptrend here. And you could kind of think of gold as like insurance on your wealth. When you're long gold, you're short the US dollar, and there's a remarkable correlation between the supply of the US dollar and the price of gold. And since we've seen an explosion in the supply of US dollars since 2020, it's really hard to see gold diverging too much from that in the medium term, especially with foreign central banks gobbling it up now too. And just like gold, its younger brother silver has a lot of industrial uses. It isn't just nice to hold and look at and wear as jewelry. It's also used a lot in the solar sector, and we've just had a breakthrough coming from Samsung and their research of solid-state batteries, which could massively increase the demand for silver and send the price higher. Market already in a supply deficit. And so this is to do with the EV industry. Samsung's solid-state batteries promise an impressive 600-mile range on a single charge and a lifespan of 20 years. These batteries can charge in just 9 minutes, which is one of the big hurdles with EV adoption. People hate waiting so long for them to constantly recharge. These batteries are nearly twice as dense as current mainstream EV batteries, and they reduce the risk of fire, making them safer. So who knows, the industry may just be scratching the surface with what's possible with silver and gold as well. They are really unique materials, and since there is only so much gold and silver out there and a huge underinvestment over the last decade, this is just another tailwind, precious metal. And there's a look at the price of silver. Not as strong as gold as of late, but still having a pretty good 2024, up about 30%. What also had a good day today was Zoom, favored from the COVID period. Jumped on better than expected results for the second quarter, lift their full year guidance. Revenue for fiscal 2025 they think will be around $4.6 billion. They just landed their largest new contract center call deal ever. Revenue rose 2.1% from a year earlier. And there's a look at the daily chart on Zoom. Pretty solid candle there today, up almost 13%. Been pretty weak this year. And just going out to a monthly chart, look at that bull market in COVID. Ripped straight up out of February 2020, $75 a share. Got up to almost 600 before it completely crashed, 90%. However, we could be nearing the end of a stage 1 accumulation. Just looking at my fundamental chart here, revenue, cash flows, and EPS estimates all trending up. It's very rare to see a high growth stock like Zoom undervalued on my fair value indicator as well. And at 21 billion market cap, I think it's actually a really reasonable valuation for Zoom Video. And we just got news Cathie Wood just dumped all of her shares as well, which I consider a pretty good contrarian signal. She'd been long for the last couple of years. Took another massive loss for all our investors. However, I think there could be a good risk reward here on Zoom Video for a 1 or 2 year hold. And so I'll keep an eye on this one going forward as well. Okay, so just wrapping things up going into tomorrow. There's Fed Fund futures. Last look before Jay speaks at 10 a.m. tomorrow morning. 75% chance they think the Fed will cut 25 basis points next month. And we're going to see how these swing around tomorrow after we hear from Jay Powell. I'll also be paying attention to the action in the 2-year government bond yield, currently at 4% going into tomorrow. 10-year at 385. High yield bonds sitting at the top of their range. The dollar at the bottom of its range. Bitcoin above 60,000. Gold above 2,500. Crude at 73 a barrel. And the S&P 500 at 55.70 after we did a bearish engulfing today. The ball's in Jay's court. Let's see what we hear tomorrow. And the market's reaction should be a real interesting one. Thanks for sticking with me today, guys. And I look forward to breaking it all down for you on the big day tomorrow. Cheers.